So good day everyone. I will be discussing about the Rule 32 of the Local Government Code, which is the shares of local government units in the proceeds of national taxes. So for the part 1, we have Article 378, the allotment of internal revenue taxes. So the total annual internal revenue allotments, or the IRAs, or now called NTAs, or the national tax allotment, due to the LGUs shall be determined on the basis of collections from national internal revenue taxes actually realized as certified by the BIR during the third fiscal year preceding the current fiscal year. So it is as follows. For the first year of effectivity of the Code 1992, 30%. B, for the second year, we have 1993, 35%. And for the third year, 1994, and thereafter, 40%. So this article establishes the local government units are entitled to a fixed share of the national internal revenue taxes, so which are based on actual tax collections made 3 fiscal years prior to the current fiscal year. So this mechanism enables a stable and predictable source of income for the LGU. So the law gradually increased the LGU's share during the initial implementation phase of the LGC. So starting from 30% in 1992, increasing to 35% in 1993, and then reaching 40% in 1994. So where it remains thereafter. So this phased approach allowed both national and the local government to adjust to the fiscal changes introduced by decentralization. Next, we have Article 379, which is the adjustment in the internal revenue allotment share. So A, in the event that an unimaginable public sector deficit is incurred by the national government, the Secretary of Finance, the Secretary of the Interior and Local Government, and the Secretary of Budget and Management shall submit to the President a joint recommendation that will institute necessary adjustments in the eras of the LGUs. So Article 379 is all about the conditions for reducing the ERA. So these articles gives the President of the Philippines limited authority to reduce the ERA allocations to LGUs, but only in extreme circumstances. So such as we have when the country is facing a serious national fiscal deficit, and B, we have upon receipt of the national recommendation of the Secretary of Finance, the Secretary of the Interior and Local Government, and the Secretary of the Budget Management, and subject to consultation with the presiding officers of both houses and Congress and the presidents of the leagues of LGUs, the President shall authorize the necessary adjustments to all the ERA to be distributed among LGUs for the given year, provided that in no case shall the adjusted amount be less than 30% of the national internal revenue tax collections of the third fiscal year preceding the fiscal year during which the reduction is to be made. C, we have the adjustments to the ERA share of the LGUs shall be made only after effecting a corresponding reduction of the national government expenditures, including cash and non-cash budgetary aids to GOCCs, government financial institutions, and the oil price stabilization fund in the central bank. So first, the reduction cannot lower the ERA below 30% of the national internal revenue taxes. And then second, we have before implementing such a cut, the President must first reduce national government expenditures and must consult with Congress leaders and LGU leagues. This article ensures that any reductions to LGU funding are made only after all other options have been considered and with the proper consultation and transparency. Next, we have the Article 380, which is the scope. So for subsection A, the ERA of LGUs shall be an integration of all allotments received by them under existing laws, such as the regular internal surcharges, the interest or fines the NGA or GOCC would have paid if it were not otherwise exempt revenue allotment. So the specific tax allotments are the STA and shares from the Local Government Revenue Stabilization Fund, LG or LGRSF. We have B. Without prejudice to the provisions of Article of Republic Act 6734, the era of LGUs under the Autonomous Region in Muslim Mindanao shall be governed by the Code and the related implementing guidelines, which in no case shall be less than the amount as determined by the computational formula provided in Article 382 of this rule. So, subsection C, the share of COA in the collection of internal revenue taxes shall continue to be governed by Section 24(3) of the Presidential Decree 1445 as amended. So, Article 380 is all about the consolidation of LGU's revenue allotment. So, this provision mandates the merging of all LGU revenue share under different laws into a single internal revenue allotment to simplify fund distribution and monitoring. So it also streamlines the fiscal transfer system and ensures consistency. So, however, it recognizes that LGUs within the BARM or the Bangsamoro Autonomous Region in Muslim Mindanao may operate under special provisions due to their unique political and fiscal autonomy. So additionally, the Commission on Audit or the COA continues to receive its share of revenues under a separate legal framework, maintaining the independence of this constitutional body. So next we have Article 381, Cost of Devolved Personal Services. So for the first year of the effectivity of the code, the 30% eras due LGUs shall include the cost of devolved functions for essential public services. So the amount equivalent to the cost of devolved personal services shall be remitted to LGUs concerned in addition to the respective era for the year. So Article 381 is all about additional era for devolved functions. So during the first year of the implementation of the Local Government Code, this article stipulates that LGUs should receive an additional amount on top of their era. So not only era, but then LGUs should receive also an additional amount aside from their era. So specifically to cover the cost of personal services, so related to the national government functions that were transferred to LGU. So this process is known as devolution. So this includes services in health, agriculture, social welfare, and other purposes. So the purpose is to ensure a smooth transition, allowing LGUs to absorb these functions effectively without financial strain. So in order for the LGUs to work well, to deliver the services to the people well, so there is the devolution of power. So meaning, services in health, agriculture, social welfare, and others has been devolved to the LGU in order for them na mas mapadali yung pagbigay nila ng mga serbisyo sa mga tao. We have Article 382, Allocation of the Internal Revenue Allotment. So the total annual era shares due all LGUs shall be allocated as follows. So we have for the provinces 23%, for the cities we have 23%, for the municipalities we have 34%, and for the barangays we have 20%. For subsection B, we have the share of every province, city, and municipality shall be determined on the basis of the following distribution formula. So for the population, we have 50%. For the land area, we have 25%. And the equal sharing, 25%. For subsection C, every barangay with a population of not less than 100 inhabitants shall be entitled to an era share of not less than 80,000 pesos per annum, chargeable against the 20% share of the barangays to the total era. So barangay each receives a minimum of 80,000 annually. So with the remaining balance distributed using a formula that initially gives equal importance to population, and then we have equal sharing. So but shifts gradually to favor population size. So as the population size is increasing, so also the era or the internal revenue allotment of the said barangay is also increasing. Next, we have D. After deducting the aggregate sum of the individual barangay share of the 80,000 pesos, each from the total 20% allocation for all barangays, the remaining balance of said 20% allocation shall be further distributed to barangays on the basis of the following formula. We have for the calendar year 1992, the population 40% and the equal sharing 60%. For calendar year 1993, we have the population 50% and the equal sharing 50%. And for the calendar year 1994 and thereafter, so until now, population is for 60% and the equal sharing is 40%. So E, subsection E. So financial requirements for the initial year of existence of provinces, cities, and municipalities to be created after the effectivity of the code shall be specified into law creating the said LGUs. So now we are down to subsection F, which is the financial requirements of barangays created by LGUs. After the effectivity of the code shall be responsibility of the LGU concerned. We have for the Article 3A3, automatic release of area shares of the LGU. So the individual shares in area of each LGU shall be automatically released without need of any further action, direct to the provincial, city, or municipal, or even the barangay treasurer as the case may be, on a quarterly basis but not beyond 5 days after the end of the quarter. So for subsection B, we have, for the purpose of implementing this article, the comprehensive advice of allotment for the area shares of LGUs for the whole year shall be released by the DBM within the first 10 days of January of every year. So the corresponding notices of cash allocations and checks, however, may be released on a monthly basis, but in no case shall the total amount of due any LGU for each quarter be released beyond 5 days after the end of the corresponding quarter. For the subsection C, the area share of the LGUs shall not be subject to any lien or holdback that may be imposed by the national government, for whatever purpose, unless otherwise provided in the code or other applicable laws or loan, contract, or project agreements arising from foreign loans and international communities. So, commitments rather. So such as premium contributions of LGUs to the government service insurance systems and loans contracted by LGUs under foreign assisted projects. And for subsection D, no LGU shall receive an annual ERA share that will be less than the total amount it received in 1991. So this article guarantees that ERA funds are automatically released without the need for further approval, so ensuring that local governments can plan and execute their budgets efficiently. So releases are made quarterly and must be completed no later than 5 days after the end of each quarter. So the Department of Budget and Management is responsible for informing LGUs about their annual ERA amount and for issuing monthly cash allocations. So this article also strictly limits the conditions under which these funds can be delayed or withheld, thereby safeguarding the fiscal autonomy. For the Article 384, we have the allocation of 20% ERA of LGUs for development projects. So it shall be mandatory for each LGU to set aside in its annual budget amount no less than 20% of its ERA for the year as a appropriation for local development projects that are embodied or contained in the local development plans. So copies of local development plans shall be furnished the DILG by the DILG. So this provision mandates that at least 20% of an LGU's ERA must be used for development projects. So these projects should be included in the LGU's local development plan, ensuring that funds are used strategically to promote economic growth, infrastructure development, and social welfare. So the plans must be submitted to the Department of Interior and Local Government for monitoring. So this requirement encourages the LGUs to prioritize long-term investment rather than short-term or politically motivated expenditure. So again, 20% of the LGU's era must be used for development projects. Next, we have Article 385, so Simplified Disbursement Scheme. So the Secretary of Finance shall, in consultation with the Secretary of Budget and Management, design and install a simplified disbursement scheme that will ensure the prompt and regular release of the individual ERA shares of all LGUs. So this article tasks the Secretary of Finance and the Budget Secretary with creating a simple and efficient system to guarantee the regular and prompt release of ERA funds. So the goal is to reduce bureaucratic delays and improve the transparency and predictability of fiscal transfers. So this system is essential for helping LGUs effectively manage their local budgets and deliver timely services to their constituents. So we are down to the part 2, which is the share of local government units in the national wealth. So Article 386, shares in the proceeds from the development and utilization of the national wealth. So subsection A, LGUs shall have an equitable share in the proceeds derived from the utilization and development of the national wealth within their respective areas, including sharing the same with the inhabitants by way of direct benefits. So for subsection B, we have the term national wealth shall mean all the natural resources situated within the Philippine territorial jurisdiction, including lands of public domain, the waters, the minerals, the coal, the petroleum, the mineral oils, the potential energy forces, the gas and oil deposits, the forests products, wildlife, flora and fauna, fishery and aquatic resources, and all the quarry products. So we have LGUs are granted a constitutional right to benefit from the national wealth. So resources such as, again, the minerals, the forest, the marine life, and water and energy that are extracted or utilized within our territorial jurisdiction or within the Philippines. So this provision ensures that communities directly affected by resource exploitation also benefit from the revenues generated. So fostering local development and incentivizing sustainable management of the natural resources. Next, we have Article 387, the amount of share of local government units. For subsection A, LGUs shall, in addition to the ERA, have a share of 40% of the gross collection derived by the national government from the preceding fiscal year on the following. So first, we have the mining taxes, the royalties, the forestry and fishery charges, and such other charges, taxes, or fees. So including related surcharges, the interests or the fines, and from its share in any co-production, joint venture, or production sharing agreement in the utilization and development of the national wealth within their territorial jurisdiction. Second, we have the administrative charges enumerated herein occurring to the national government, whether collected by the national government, collecting agencies, or in certain cases by LGUs. And then third, proceeds from the development and utilization of national wealth, where the LGUs actually collects and automatically retains its share of at least 40% of such proceeds, shall not form part of the revenge based on the computation of the 40% share. So aside from the ERA, LGUs are entitled to 40% of all gross revenues collected by the national government from taxes, fees, royalties, and similar charges related to the exploitation or use of the national resources within the territory. However, if the LGU is the one that directly collects these proceeds, the amount is excluded from the base used to compute the 40% shares. This ensures no double counting and promotes fairness in the revenue sharing. We have Article 388, share of the local government units from any government preceding the fiscal year from the proceeds derived by any NGA or GOCC owned or controlled corporation. So LGU shall have a share based on gauge in the utilization and development of the national wealth based on the following formula whichever will produce a higher share for the LGU. We have subsection A, 1% of the gross sales or receipts the preceding calendar year, or 40% of the mining taxes, the royalties, the forestry and fisheries charges, and such other charges, taxes, fees, including related surcharges, interest, or fines by the NGA or GOCC would have paid it if it were not otherwise exempt. So this article ensures that LGUs receive their share when government agencies or government-owned or controlled corporations earn revenue from the national resources within the LGU boundaries. So LGUs are entitled to either 1% of the gross sales or receipts of such agencies or 40% of the relevant taxes and charges. So whichever is higher, the provision guarantees that LGUs receive a meaningful share even revenues are declared low. So allocation of shares. So the share is in the immediately preceding article shall be distributed in the following manner. So we have subsection A, where the natural resources are located in the province. So for the province, we have 20%. For the component city or municipality, we have 45%. And for the barangay, we have 30%. Provided that there where the natural resources are located in 2 or more provinces or in 2 or more component cities or municipalities or in 2 or more barangays. So their respective share shall be computed on the basis of. So if ever the natural resources is found or located between 2 or more provinces or 2 or more municipalities or cities or barangays with 2 or more or in between sa ilaha, so their respective shares shall be computed on the basis of you have the population 70% and the land area 30%. Okay, subsection B, we have where the natural resources are located in the highly urbanized or independent component city. We have for the city 65% and for the barangay we have 35%. Provided that there where the natural resources are located again, for example, in 2 or more cities, the allocation of shares shall be based on the formula on population and land area as specified in the subsection A paragraph hereof. So we have Article 390, the computation of remittance of the shares of the local government units. So the computation and remittance of the shares of LGU shall be in accordance with the following procedures. We have the computation of the 40% share of an LGU in the proceeds from the development and utilization of the national wealth from the preceding year, indicating the corresponding share of each province, city, municipality, barangay where the national wealth is being developed and or utilized. So in summary, this is all about the timely release of the national wealth services. So this article clearly states that the government agencies are responsible for collecting revenues from the natural resources. Use must compute and submit the 40% LGU share by March 15th of the year. So funds must be released quarterly, so similar to era distributions, and cannot be withheld or delayed. So if the collecting agency is a GOCC or a national government office, it must remit the LGU share within the 5 days after the end of each quarter directly to the local treasury. This provision enforces fiscal discipline and strengthens local autonomy. For the last article, we have the development and livelihood projects. So the proceeds from share of the LGUs referred to in Article 386 of this rule shall be appropriated by the respective sanggunian to finance local development and livelihood projects, provided that at least 80% of the proceeds derived from the development and utilization of hydrothermal, geothermal, and other sources of energy shall be applied solely to lower the cost of electricity in the LGU where each source of energy is located. So this article outlines the intended uses of LGU shares from the national wealth. Proceeds must be spent on the development and livelihood projects. So a while ago, I have already discussed about the shares of the local government that is um, that is intended for the development projects of a barangay. So, in this case of the income from energy resources like geothermal or hydroelectric power, at least 80% must be allocated to reducing electricity costs for consumers within the host LGU. So this promotes equitable sharing of resources, the benefits, and addresses local and environmental and social impacts. Lastly, we have the Article 392, the monitoring and implementation. So again, I think in every part, in every rule of this constitution, we have the monitoring and evaluation because it is very important for us, in order for us to know that is this provision um, effective enough, or is this provision benefited the people, so that in the latter part we can either suggest or recommend any other ideas to further enhance this provision. So the DILG, in coordination with the DOF and in actual consultation with the leagues of LGUs, shall monitor the proper implementation of Part 2 of this rule. So, to ensure the compliance with all the provisions on revenue sharing, this article mandates that the Department of Interior and Local Government, in coordination with the DOF and the National Leagues of LGUs, monitor the implementation of the rules. So, this collaborative oversight ensures transparency, accountability, and the effective use of public resources in line with national policies and priorities. Again, my topic is all about Rule 32, the shares of local government units in the proceeds of national taxes. So that would be all. Thank you.